Hello, and welcome to the DSM Wealth Podcast, sponsored by Revol One Financial, who is here to revolutionize how people feel, think, and experience retirement solutions. I'm your host, Suzanna de Baca, and I'm so glad you're here. On this show, we redefine and explore our relationship with wealth. Each month, I talk with leaders to uncover practical insights on creating prosperity and meaning. Today, let's start with a question. What is the secret to knowing where to invest right now? Everyone wants to know that answer, especially during times like these when markets feel volatile and the economy looks uncertain. It's natural to wonder if your money is in the right place. But most experts will tell you the real key isn't chasing the perfect investment. Instead, it's something much simpler. Like my grandma said, not putting all of your eggs in one basket. This idea is known as asset allocation, and understanding it may be one of the most important steps that investors can take to build and protect their wealth over the long term. That's what we're going to be talking about in today's episode. Where should I be investing now? Asset allocation for the modern age. And to help us explore this topic, I'm joined by two terrific guests. Very excited to have our expert panelists here. The first is Dr. Tyler Jensen. Hi, Professor Jensen. He is an associate professor of finance at the Ivy College of Business at Iowa State University. And his research focuses on corporate finance and asset pricing. He teaches both undergraduate and graduate students while also advising the Ivy Investment Banking Initiative. So welcome, Professor Jensen. Thanks for being here.
Good morning. Thank you.
Also delighted to have Ed McGill here. Hello, Ed.
Hi, Susanna.
Ed is the co-founder of McGill Junge Wealth Management. And since founding the firm, the team now manages $2 billion in assets. Ed specializes in wealth management and retirement planning strategies. He's also been recognized as one of Barron's top financial advisors, and he hosts a podcast, Leadership with Ed. So welcome, Ed. Glad you're here.
Awesome to be here. Looking forward to it.
Wonderful. So today we're going to talk about how investors should think about diversification, risk, and portfolio strategy. That sounds very academic, but we're going to try to demystify it. So let's dive in. So when we say asset allocation, what does that actually mean in plain English? And why does it matter at every level of wealth? Ed, let's start with you.
Yeah, great question, because it is something that gets mentioned in almost every article. And really, asset allocation is about dividing your resources into, different investments in order to achieve, these financial goals with an acceptable amount of risk. And acceptable amount of risk is, do you have those assets at the time frame that you're going to need them? What can make it hard for the consumer is asset allocation then says, which assets into which buckets, as well as also how much in equities versus bonds. So you start with the high level of the asset allocation, then you start working down from there. But ultimately, you're looking to design a portfolio to make sure you have assets at the time frame that you're going to need them based on your goals and objectives.
Excellent overview. Professor Jensen, what is asset allocation?
Yeah, I think Ed gave a really good answer there. Asset allocation, as you mentioned, you don't want all of your eggs in one basket, but it's important to understand what eggs you have available to you and what baskets you have available as well. And so when we think about different asset classes, stocks, bonds, real estate, commodities, a variety of options that are available to us right now, it's understanding the mix of those and what fits your own investment horizon and your investment objectives, and then choosing an appropriate mix to match with those preferences.
Mm-hmm. Excellent. So Ed, let's go into real life. You advise clients. So when you sit down with a client who says, Ed, where should I be investing right now? The markets are crazy. What should I do? How do you actually guide that conversation, kind of according to what you were talking about?
Yeah, so with our clients, for us, it always starts with that comprehensive plan. It really is that roadmap to say, well, where are you trying to go? When are we going to need these dollars? What are the goals and objectives? How much income that you look with? So you're trying to divert the attention from what's now to truly what are we solving for? We run into so many clients where they'll have different investment accounts, and I'll say, well, where does that fit in the investment plan? And what are those dollars designed to do? And a lot of times they don't know. Well, my buddy told me about this, or I did. So they have a lot of one-offs that aren't really talking to each other, not working in alignment. The other thing too, Suzanna, which I found interesting, is when I first started, the way you determined someone's asset allocation is you had them fill out an investment questionnaire. It could range anywhere from 6 to 18 questions. And this is what employees get if they're doing their 401k, asset allocations, etc. And unfortunately, you'll typically fill them out the way you're feeling that day. So if you picture maybe going back to 2020 in January, how you would have filled out the investment questionnaire, would you stay invested in the market? You're like, oh, yes, of course. I know I need to be a long-term investor. And then COVID hit and the markets drop in March by about 35 to 40%. And you fill it out in April. You're like, no, I'm putting everything underneath my bed. And part of that then is because of that emotion that's tied in there. So maybe quick too, and Tyler knows this because he teaches corporate finance. My business partner, Ross, who came from Aviva, where he was chief investment officer, he had a term called LDI, which is liability-driven investing, where you're investing based on those future liabilities. So for an insurance company where he worked, he knew those future liabilities and they would invest for that. For our clients, we try to get them to focus that the comprehensive plan is telling us what are your future cash flows you're going to need to maintain that lifestyle on this glide path into and then through retirement. And those are the future liabilities. And so we can build that portfolio then based on when those outflows are going to be needed. So when they say, where should I be investing now? It's more, well, what's the time frame for those dollars? If they're short term, we really should just be in cash so that they're not subject to market risk. And their longer term dollars, we want to be hedging against inflation, which means a higher weighting to equity. So I think it's more getting people to say, don't listen to the short term noise because you walk by again someone's desk and they had on CNBC or Kramer or someone and is saying different things, but always looking at where does my plan say I should be investing and what is the time horizon?
Mm-hmm. Yes. So tune out the stock tip of the day and think about your goals and objectives longer term. So let's dig into like this whole concept of asset allocation from a little bit more academic perspective. So yep. Professor Jensen, how does modern portfolio theory explain all of these relationships between risk and return and diversification? Why is that relevant today?
Yeah, I think that's a really good question. And I think the relevance of diversification and this risk return balance has never gone out of style or out of fashion. It just looks a little bit different from time to time. And so modern portfolio theory is really built on the simple principle that as human beings, we want the maximum amount of return that we can generate for the minimum level of risk that we're willing to accept. And so we don't want to invest in assets that are either going to be too risky or deliver too little return relative to the rest of our portfolios. And so we want to form something that's well diversified so that we can achieve maximal return per level of risk that we're willing to accept. And so again, that could look different depending on your individual preferences, your time horizon for investment, your risk tolerance, but we don't want to be distracted or investing in things that are too volatile or too risky and not delivering a commensurate return for that. I like to use the term, the juice is not worth the squeeze at that point if you're having really volatile assets in your portfolio that aren't significantly contributing to return.
Susanna, could I add a piece to that? Because I love what he said there about being distracted, and maybe going back to the question, where should I put my money now? That's where the distraction comes into play, because if you have a long-term focus on your plan, this short-term noise, that's why when you said distraction, I was thinking about that. Like, depending on when this podcast drops versus what's going on right now, there's a lot of things going on geopolitically and just, in the country, that you can be paralyzed or make decisions, or someone can read some of those, we call them catastrophe people on TV, that everything's a catastrophe, everything's a recession, everything's this, and they need those clicks to get you to open it. And if they said things look really good, you're probably not going to open it. But if it says 8 reasons now why not to do X, then people click on it. So it's this habit of what the media does to get you to click and open on things. And I love how Tyler said distraction. Then there's a lot of noise and distractions that will get you off that long-term plan, which ultimately will typically hurt you in the long run.
I want to take a quick break now for the Revol One Financial Sprint Series, which is your rapid update on financial news, market perspectives, and retirement planning insights.
All right. Hey, welcome to the Revol One Financial Sprint Series. My name is Adam Carroll, and in the next few minutes, we're going to tackle one important financial topic and give you some practical insights that you can put to work right away. So let's jump in. My guest today is Patrick Cahill, who is the Chief Distribution Officer at Revol One Financial. Patrick, we're coming right to the source today, but for our listeners' sake, will you let them know who you are? Tell us a bit about yourself and your background, and why that topic today we're going to talk about is so important for the audience.
Adam, I've never heard straight from the source, so I'm appreciative of that as well. My name is Patrick Cahill. I lead our sales distribution efforts here at Revol One Financial. I've had the good fortune of being in the business for over 25 plus years in the financial services industry, with various roles from sales, business development to sales leadership roles. But Adam, we've never had so much fun, leading the charge here at Revol One Financial the last 2 years. I mean, we're leading the charge on how we revolutionize how people think, feel, and experience retirement solutions. And just delighted to have this opportunity with you here today.
I love it. Patrick, to level set for our audience just a bit, I know that y'all are into the fixed index annuity scene, but tell us, what is an annuity?
Yeah, very simply, Adam. I mean, an annuity is a contract, with an insurance carrier, right? With an owner and an annuitant of a policy. So it's purely an insurance contract that has 3 components to it that I think are just, so profound as you start thinking about, retirement. First and foremost is tax deferral. You have the benefit of compounding of interest of your investments. Number 2, with fixed index annuities specifically, you have a level of principal protection, and also you have the ability to participate in index returns within your annuity. Finally, you have a level of guaranteed lifetime income, inside of annuity contracts. So with tax deferral, principal protection, giving you the ability for upside of the market growth and downside protection with a layer of certainty for income, is a profound, meaningful solution to consider as a portion of your retirement portfolio.
How much of that is income planning as you look into the future for a financial plan for a retiree?
It's all income planning, right? They say all roads lead to income, but I think when you look at income planning, the analogy I would love to use is, when we're growing our assets, right? When you are in your 30s, 40s, 50s, accumulating assets, right? It's completely different in the distribution mode. And we talk about sequence of returns risk. It's a lot like climbing Mount Everest.
Yeah. You mentioned this inside a portfolio. It suggests maybe a holistic approach to retirement strategy.
Absolutely. It's all a balance of, you have your life, your health, and your wealth, right? So how do you find that holistic approach? When you try to align your essential expenses with your discretionary expenses and then your legacy goals, right? We talk about the needs, the wants, and the wishes of retirement, right? Mm-hmm. It's always good to have that essential bucket, covered with guaranteed streams of income. And that could be Social Security. That could be a defined benefit. That also could be an annuity, providing you that essential, sleep at night type of solution to cover your bare minimum essential expenses in retirement.
Yeah. How does someone get started in this conversation?
I mean, family dynamics. I know it's where it started at, at the Cahill household. I remember I was in high school, my dad was a lieutenant commander in the Navy, and he started drawing down his pension, back, in the 1990s. So to me, it was just family dynamics, where it originated in our household. Thankfully, my wife and I have both been in the business for, over almost 30 years. So that's a conversation that we have with our daughter, who's 17-year-old right now. But I think the most important thing to research is consumer education and also having a financial coach. You look at every professional that's out there, look at Tiger Woods as an example, right? You always have a coach to get better at your game. Reaching out, to a financial professional as well is very, very important as well.
So good. Such valuable content. Patrick Cahill, thanks for being on the Revol One Financial Sprint Series. We'll see you on the next episode.
Yeah, I appreciate it. Thank you for taking the time.
Right now, things feel very uncertain. They may be feeling uncertain, for the foreseeable future. Inflation, interest rate risks, the geopolitical risks that you talked about. So why is this concept of asset allocation more important than ever when things are more volatile? So, Dr. Jensen, let's go to you on that.
Yeah, I think as Ed said, again, you don't want to take the current time as a special circumstance or attempt to deviate from this plan that you've established for years just because you think the current moment is special or different or unique. You shouldn't deviate from that objective set that you've set up and been following for years. And it's difficult to do. I find myself getting distracted or having opportunities that I think are out there, but understanding that if there's something that pops up today that I think is a good investment opportunity, it's not going to change what I'm saving for retirement. It might change the vacation that we go on this summer with my kids, where I'm going to change a tiny fraction of my portfolio to take advantage of some short-term opportunity, but it's not going to change 20 years down the road what I'm looking at for my retirement portfolio. So I think understanding that, yes, there might be short-term opportunities that are unique to each time period, it doesn't change that overall perspective of having a long-term plan and a long-term set of objectives that you want to maintain regardless of current events or things that you might think are especially volatile at the current moment.
That's great.
Yeah,
Ed, what do you want to add? Mm-hmm.
Yeah, I would add to that it doesn't mean that you aren't modifying or taking into account the information that's out there. If you think of really the trends over the last decades that have served us so well, where you have relatively low inflation, you've had interest rates come down, really over a 50-year, time period. You've had, emerging markets and just international, company or countries just growing and developing. Some of those trends and things that allowed maybe some simplicity in the portfolio may not be, the trends going forward. So you do want to think through, what maybe changes in terms of tweaks based on that information that you want to be doing. So, here at McGill Junge, we're always looking at how do we make these portfolios resilient in multiple market environments. Our clients typically are not looking, to necessarily have the home run, but to say, how do I always get on base? How am I always getting doubles and triples and always being in the game, always scoring runs? Because they typically do have a decent net worth. And so I hope people listening to this doesn't mean that there aren't tweaks, there aren't, some tilts and things that you're doing based on what you're seeing, such as, recently, overweighting international when U.S. had been doing so well for so many years in a row. It's really avoiding those big mistakes and big changes because of something you read or saw is really what you're trying to avoid then. But there's definitely tweaks and modifications going, but keeping that foundational asset allocation strong, Suzanna, is what we're seeing.
At Revol One Financial, we have the cheetah spirit, that drive to move forward, be sharp, and deliver on what's next. I'm Mark Zesbaugh, Chairman and CEO of Revol One Financial. We built this company to move with that same energy, to always be agile, nimble, and execute at the highest level. redefining how people feel, think, and experience retirement solutions. Revol One Financial is a national insurance company providing retirement solutions in 49 states, created to provide financial professionals and their clients with outstanding products, service, and flexibility to embrace retirement boldly. So whether you're building your business or planning your future, don't stand still. Go find your cheetah spirit and unleash it. To learn more, visit revolonefinancial.com.
So let's stick with you, Ed. And you've mentioned a lot of different asset classes. So many people have heard you've got stocks, you've got bonds, right? But then all the international things, growth versus value, real estate, blah, blah, blah. What does smart diversification really look like with these different kinds of asset classes in a portfolio?
Well, what we've seen, which is interesting, is that, you can now access a lot of themes and strategies that used to only be available in the institutional world, even like 5+ years ago, in these relatively inexpensive liquid wrappers. I think about just how the ETF world has changed, that if you want an emerging market fund, but you wanted to be, ex-China, just for whatever reason, you can find an ETF that's, ex-China. There are things you can do with, managed futures and trend following. So when you become an accredited investor or a qualified purchaser, there can be other things that start becoming available that are outside the normal stocks and bonds, which can add different return and different risk characteristics. So it's adding different asset classes above just the normal stocks and bonds too, that can start rounding out that portfolio. Now, what you have to be careful of is in the wealth management industry, or just in general, a lot of times ideas just get repurchased, repackaged, and you have to have a higher, and Tyler's nodding, because you have to have a higher level of due diligence, because there can be a lot of fees. There can be products that create a lot more taxation. They can add complexity, with going back to what Tyler said, of not giving you the extra return for that complexity. Or when you look at you have to be very fee conscious and tax conscious in today's environment, more than ever, on that side then too. And I wrote this down because Jason, our director of investment, said, you've got to be careful of boomer candy. And what he said was, all these products being packaged of, boy, you can get all the upside return with no downside risk. And these products that are very complex and expensive, that, you can't get higher return with no downside. It doesn't exist. You are paying for that upside limitation to give you the downside protection. So there are some things out there that are making it easier to access different parts of the market very inexpensively, but you do have to have another layer of due diligence, because there's just a lot of junk out there actually too.
So I'm hearing you need a lot of eggs, you need maybe baskets, but sometimes those baskets can be packaged, and then you've got to look really carefully at you've got to do your research on them, right? That's where good advisors can come in, I'm guessing. So Dr. Jensen, yeah, so we've talked a little bit about, the academic part of it. How has this understanding of diversification evolved, especially now as we've gotten so much more global? There's alternative asset classes, there's, different kinds of investments out there.
Mm-hmm. That's a really good question, because I think the underlying principle of diversification is still the same that it's always been. It's a mix of risk and return that you're seeking. But the way you put together that mix is completely different, because we have so many more choices than we ever had before. I think about, in the last few years, how does cryptocurrency factor into this traditional portfolio that we had in stocks and bonds? And lots of my students get super excited about crypto, and I've been trading crypto for years, and you have to do this and you have to do that. And I've always been a little hesitant about, okay, what is the objective that you are trying to fulfill by this cryptocurrency investment? It sounds like it's to make money in the short term, which is an okay objective to have. It's just different than the reason that I invest. And so just understanding which of these assets fit with your plan and which don't. And in terms of cryptocurrency, if you're trying to save for retirement that's 1, 2, 3 decades in the future, I'm not sure how well that fits your plan. If you're trying to make a quick buck and with some money that you aren't worried about losing, then sure, by all means. But I think that's different than wealth management and saving for kind of a long-term horizon. And so, like Ed mentioned, it's a lot easier to get diversification, but it's a lot easier to make mistakes too, especially because there's more assets out there that I don't think we fully understand and comprehend how they fit in with the rest of our portfolio strategy. And so I think doing your research is even more important than it's ever been to make sure you're maintaining that good balance and that good mix.
Mm-hmm. So Ed, you mentioned, adjusting the portfolio, tweaking, either buying or selling. So rebalancing can kind of feel counterintuitive. You're selling what's working and buying what's lagging. How do you help clients think about staying disciplined and avoid that emotional decision making?
Yeah, great question. And when I think of rebalancing, maybe tied to two parts there, the education part, but the rebalancing first. If I think about what our team was able to do, during that COVID year, if you think of the year prior to 2020, the markets were actually, the equities were very positive. So let's say, as an example, you were 70-30, or that was your target allocation, 70% equities, 30% fixed income. And at the end of 2019, that might have been 74, 26, just because of how equities had risen. And so at the start of the year, we did rebalance people back to the 70-30, which can be counterintuitive of, well, this went up and now we're selling, but we had our target allocations. COVID hit, and now our clients' portfolios, just like everyone else's, went down. They just didn't go down as much because we had reallocated some dollars out of equities into bonds. But what was interesting is by the end of March, now it might have been 60-40 because of how far the equities fell. We rebalanced again at the end of March for our clients, actually tax loss harvested, which is a conversation for another day of, selling and creating some losses. But now when the markets went up dramatically from April on that year, our clients got to participate at a higher percentage because they had now rebalanced back to more in equities, which saw that rebound. And what we found is by that active rebalancing, two things happened, Suzanna. Is one, we actually created, some extra alpha because of that, but also created some losses to offset gains in a year where things were positive on that side. And then the other part with education is, I think a good wealth management firm is always going to help the client understand that there is an admission price to pay to be buying equities. Everyone would love the higher long-term returns, but they don't go 8, 9, whatever. There is going to be market volatility, and you have to be able to have a plan you believe in and a team you believe in to absorb that volatility so that you can see and earn those higher returns long term. And there's a lot of just really good, graphics that show, when you look at every 1 year in the market, 74% of the time the markets have been positive and 26% of the time they'll be negative. So that there's a 75% chance the market's going to be positive in any given year. When you look at 15 years, you can see every rolling 15-year average equity markets have been positive, but the people that saw the positive returns were the ones that stayed in it. And the last thing, sorry, I'm rambling a little bit, but I love this. JP Morgan puts out a great slide, and it's called intra-year decline, and educating the clients that in any given year, on average, at some point during that year, even if the market ends up positive for the year, on average, the market will drop 14% at some point during that year. So helping them understand that there is this volatility that is the admission price to pay to get those longer term returns. And so when those things happen, then our clients are expecting them. We actually don't get a lot of calls when there is some of the, kind of madness going on, because they've been educated everything is tied to their actual financial plan. We've built for it, we plan for it, no reactionary decisions then.
So that's great. I've got just two more questions, and that leads in beautifully to this one is, so when someone actually says, what does a resilient portfolio in 2026 look like? How do you actually answer that without oversimplifying? And so, Ed, let's go back to you, and then we'll go to Professor Jensen. And then I'll have a wind-up question for you. Mm-hmm.
Yeah. So, yeah, Tyler's going, why'd you let Ed go first? It's going to be too long. So if we think about it, for any of your short-term needs, and especially as you head closer to retirement, we're going to be building up your cash reserves and making sure we always have that 3 to 4 years worth of living expenses, so that volatility, as what we call the critical 10, the 5 years heading into retirement and the 5 years in retirement, that first 10 years total is where market volatility can have the biggest impact of whether or not you're going to run out of money or not. So we always want to plan and build for those early years of retirement and taking some chips off the table as we head into that. And then that diversified portfolio, depending on your level of net worth and your risk tolerances, again, having the U.S. large cap, mid and small, we're going to have that international percentage. We're also then going to say, where do some of the alternative assets fit in there, such as, again, can range from the managed futures to, the private debt, private credit, private equity, things like that, but making that portfolio resilient so that there is always a asset class typically always doing well at any time, as others are now maybe rebounding on that side then too. So it really is looking at, hey, the things that you may not like in your portfolio today, in a year or two, more than likely is going to be the part of the portfolio you're going to like. So let's stick to that asset allocation.
Mm-hmm. Excellent. Professor Jensen, what does a resilient portfolio look like if someone just asked you that question?
Yeah, and I'm always happy to let Ed go first, and I can just copy his answer. But I think a resilient portfolio maybe looks different today than it did in the past.
Definitely.
In terms of the assets, but not in terms of the objective that you're trying to achieve. One thing I've just been thinking about and looking at recently is, for many decades, if you wanted broad diversification, you could just invest in the S&P 500 and get sensitivity to a huge basket of stocks. In the last couple of years, you're basically getting sensitivity to 7 or 10 stocks in the S&P 500. And so understanding that diversification is no longer existent necessarily in just a market index. And so that's where all these other asset classes that Ed was mentioning, private debt, private equity, real estate, commodities, all these other things need to be part of that basket, because you can't just get that in the S&P 500 anymore.
Diversify. So wonderful. Mm-hmm. Okay, my last question for you, just some closing wisdom very quickly. What is one guiding principle you would offer our listeners about building an asset allocation strategy that aligns with their goals and helps them invest with confidence? Ed?
Okay, I'm going to have two guiding principles, sorry. The first one is that our clients that are happiest in retirement are the ones that match their fixed expenses or their fixed income that they need with fixed payments. It's a little bit harder to do nowadays because people don't have pensions anymore, those unicorns, that everyone loves. But there are ways, if you read the academia research from Dr. Pfau or Dr. Finke, that talk about ways you can create almost like your own private pension. And so picture guaranteed streams of income, Social Security, pensions, and these other tools that are out there to provide that baseline amount of income, so you're never going to run out of money. And then it takes a lot of the thinking away from your diversified portfolio, because now some of the market volatility isn't weighing on you as if your entire retirement income was coming from that. And then the second thing is, you need to find a plan that you believe in and you're comfortable with, that you can stick to when things ultimately are going to go crazy. And that will help modify the behavior management. So there's a number of different ways you can solve these problems. Just find the one that you believe in and stick to it, when things maybe look a little bit out of control. And those are the people that end up being the happiest in retirement.
Mm-hmm. Professor Jensen, what's one guiding principle you'd offer the listeners about building an asset allocation strategy in 2026?
So one thing that I always tell my students is, with the speed of information and all the access we have to so many different asset classes, it's very easy to trade now. It's very accessible, which I think makes it also very easy to make mistakes and make errors. But fixing those errors is just as easy. And so if you realize you've made a trade that's deviated from your strategy, deviated from your plan, just undo it. You don't have to call your broker anymore and pay a trade commission.
Yep.
You can just undo it on your phone or your computer, as easy as that. And so if you worry, or if you're concerned about you've made a decision that you're uncertain of, just fix it. And it's easier to do than ever before.
Mm-hmm. I love that. I love that. So, well, this has been a great conversation. And the takeaways I'm hearing overall is, first, long-term success comes from building the right mix of assets for your specific goals. Secondly, diversification helps manage risk, especially in volatile or uncertain markets. And third, your asset allocation should evolve over time, reflecting your goals, your stage of life, and your changes in the market. Advisors can help. Do your research. So, thank you to our exceptional panelists for sharing your insights. And thank you for tuning in to the DSM Wealth Podcast presented by Revol One Financial, here to revolutionize how people feel, think, and experience retirement solutions. For more information, visit revolonefinancial.com. I hope you'll join us next time as we explore the roots of wealth, understanding the power of land ownership. From productive farmland to conservation acreage, land has long been a powerful driver of multi-generational wealth and lasting legacy. So we hope that you'll join us for that. Thank you for being here, and have a great day.